Okay, I think everything is sorted, if I'm not mistaken. Let's just wait another few minutes for everybody to come on. Quick second. Okay, let's see. All right. Just stick with us for a second, ladies and gents. Yeah, thank you. All right. Finally works. Brilliant. So I can hear myself in the background. Good day, ladies and gents, fellow traders. Excuse the delay, a little bit of a tech issue that we have had. It won't happen for future reference. Welcome to our webinar series in regards to supply and demand imbalance. Everything that we will be discussing in these particular episodes is based indeed on microeconomics, which is, in the end of the day, supply and demand imbalance. It is one of the most important models of price determination extracted from microeconomics. So we'll be starting, in a sense, with the definition of supply and demand itself, in order for us to understand exactly why price is moving into any market. It could be the foreign exchange market, it could be commodities, it could be the real estate, it could be the price of a gallon of milk or the price of a brick. It doesn't really matter what it is, as long as there's a certain asset. We can obviously establish supply and demand imbalance zones by using microeconomical models of prices determination. So if we start from the definition of supply and demand itself, supply and demand is, as we said, a microeconomical model of price determination into any market. And it stands behind the point that in any competitive market, the unit price of a good will vary up to a moment, most importantly, a price in time in which quantity demanded by consumers pretty much equals the quantity produced by supplies. And that's when we find ourselves in an economical equilibrium in price and quantity. So as we said before, as I said, once again, so supply and demand imbalance is a microeconomical model of price determination into any market. And it stands behind the point that in, as I said, any competitive market, foreign exchange, commodity, real estate, whatever the market may be, any competitive market, the unit price of a good will vary. As we said, up to a moment in time in which quantity demanded by consumers pretty much equals the quantity supplied by producers. And that's when we find ourselves in an equilibrium in price and quantity, as you will see here on the chart as well. Using price elasticity, using certain, let's say, rules of supply and demand imbalance, specific rules of supply and demand imbalance, we will then, of course, be able to use this particular analysis in order for us to understand where the market will be going in regards to any asset. Supply and demand imbalance is a way of a trading strategy that can be used on a very short amount of time. Even scalpers are able to use identified or pre-identified supply and or demand imbalance zones in order for them to be able to make a quick back onto the market. But in regards to who uses this mostly are indeed institutional traders, bank traders, hedge fund traders, and so on and so forth, that have the buying power in the multi-millions and billions as well. And they're looking into a slightly longer, let's say, time frame in regards to supply and demand imbalance. But nonetheless, when we will be understanding exactly how to identify these levels and how to understand if we are in a downtrending market or uptrending market or a ranging market, then we will be able to take these particular rules and apply them into the time frames that of course fit your personality and most importantly fit your risk money management as a trader. In the end of the day, to be fair, risk management is pretty much the most important part when it comes into your trading strategy on a day-to-day basis. Give me a quick second. Give me a second, I'm gonna... Again, we had a little bit of an issue. Can you check the link and just make sure that everybody can see? Yep, it's okay. I have the okay. It's okay. Everything is great. So just to move forward, as I was saying before, once we understand how to establish these particular supply and demand imbalance levels, we'll be able to use these regardless of the time frames that you're using in regards to your trading. 1 minute charts, 5 minute charts, 15 minute charts, daily charts, weekly, monthly. When we're talking about the present parties like myself, for example, I use 6 months, 3 months, and monthly charts in order for me to look at the long run, in the long term aspect of the market. And in order for me to actually take the trading decision itself, I am using a monthly, weekly, daily sequence. Sometimes we're looking at a weekly, daily, and 4-hour sequence. But a very, very important thing to understand, regardless of what you're using, but we're talking supply and demand now, is that the lower the time frame that you're looking on, of course, the higher the volatility onto the market, right? So in the end of the day, if I'm using a, let's say, 5 minute, 15 minutes, and half an hour trading sequences, we always choose the 3 different time frame trading sequences in order for us to take the actual decision on the trade. We will be going through that probably in the 3rd and 4th episode of the series. But nonetheless, just to give you a little bit of a broad understanding of microeconomics, most importantly what supply and demand is, and then we'll be able to go into charts at some point for future reference once we understand what exactly supply and demand is. So simply put, yes, we went through the definition of supply and demand. Yeah, microeconomical model, as I said, price determination into any market. We now have to, in a sense, break it down and understand what supply is. Of course, a few supply rules that make us understand if we are going to witness a supply increase or decrease within a market, and what factors actually help us identify these particular things. So looking at supply per se. So supply, as we clearly see on the slideshow here as well, is the amount of value that the market participants are willing to provide to the market at a price level. On the other hand, demand is the amount that the market participants will buy at a certain given price. So if we go back to the definition of supply and demand, we know that the supply is the value that the producers, people that supply a certain asset. In other words, if you're looking at the market from buying and selling perspective, suppliers are the people that are obviously shorting a certain asset. Yeah. Obviously, from another perspective, we're looking at demand as being, of course, the amount of the consumers, so purchasing, the buyers of the actual market. So if we split supply are the sellers and demand are the buyers, right? Looking on the price versus quantity chart here, we remember from the definition of supply and demand imbalance that we have a certain moment, most importantly a price in time, in which quantity supplied by producers, as we said, pretty much equals the quantity supplied by producers equals pretty much the quantity demanded by consumers, right? So the quantity of the sellers equals pretty much the quantity of the buyers, and that's when we find ourselves in an equilibrium. According to the 4 different rules of supply and demand, the market will suffer a shortage or a surplus, and of course the price will be established at a higher or a lower price in regards to the actual equilibrium itself. And that's when the market pops to the upside or of course falls to the downside. Nonetheless, just to move forward, when we're looking in an efficient market, just to continue on our slide, when we're looking at an efficient market, price and quantity occurs at a point, as we said before, where the supply curve meets the demand curve. So quantity supplied by producers, quantity that the people are selling, shorts, pretty much equals, when they meet the demand curve, is pretty much equals the amount of buy orders, and of course in regards to the volume as well, into the actual market. And as we said before, this point is known indeed as the equilibrium between supply and demand. Give me a quick second. So what exactly equilibrium prices, just to understand exactly a little bit on the equilibrium, and not only that, when we're going to go on the charts and we'll look at equilibrium on an actual candlestick chart, equilibrium shows in a ranging market, right? If I quickly go to trading view, just to give you a quick understanding, right? Give me a quick second. We choose any asset. We'll go for whatever, gold, for example. It's already on the chart. When we, as we said, when we look at an equilibrium, we know that a market, it's actually ranging. So once we have ranges in the markets, for example, this portion here, it's equilibrium. Price increased in quantity. There were either a shortage of supply or an surplus in demand. The market took a little bit of an upside here on a daily chart. Then we're looking at this particular group of candles. We've got 1, 2, 3, 4, 5 different candles where price doesn't seem to break above nor below, and that's when we call it an equilibrium in price and quantity. Okay. There will be ways, and I'm going to show you exactly how. There will be ways in which we will be drawing these particular levels onto the chart. So I'll give you a very simple example. We have made a few shorts last week, and once we're going to start trading supply and demand, 3rd, 4th episode, you guys are going to understand much better how to use these particular zones in order for us to obviously trade them. But nonetheless, if I had here as a supply zone, rally, base, drop, base, drop. So this particular candlestick formation here, 1, 2, 3 candles, represent equilibrium in price and quantity. And I know the last time when we were here, the market went to the downside. So it broke to the downside, which means that either demand was decreased or actual supply was increased. And from that perspective, the market required a what? A lower equilibrium in price. So market needed to go to the downside according to the orders on the actual market itself. So if I'm going to use a rectangle to draw that particular equilibrium area, that equilibrium area zone was here. And as we clearly see, the next time that the market came to that particular zone, orders of the institutions have been filled in, and the market actually respected that particular supply zone. We clearly see that that particular supply zone was broken, and the next potential supply area that we have in order for us to look into potential short positions would be right there. I'm not going to go into how we draw these particular areas, but we see that this is almost reached. Does that mean that we will be selling every single time we see supply? Absolutely not. Does it mean that we will be buying every time that we see a demand imbalance zone? Absolutely not. Everything has to do with the core rules of supply and demand imbalance. So we need to firstly understand the trending direction of a certain market. If we're in an uptrend from a weekly perspective, according to certain rules, which we will be going through, we will take certain decisions to either go with the trend or, of course, counter trend trades, which a lot of scalpers actually love. But to go back to the theory itself. So we've already established what supply and demand imbalance is from a microeconomical perspective. It is the core of price determination models when it comes to any asset into absolutely any market. Yeah. Moving forward, so as we already discussed, as we said, we have the equilibrium between supply and demand. Equilibrium prices, yeah, and quantities. Give me a quick second. So supply is the amount of the value that the market participants are willing to provide to the market, as we said, at a certain price level, and demand is the amount that the market participants will buy at a certain given price. Regardless of where we stand in a certain market, we will always, as I said before, have shortages or surpluses based on market orders and institutional order flow. And of course, the market will take a higher point, a higher price, or a lower price, as we said, in order to establish that particular equilibrium. Right? Now, in any efficient market, if we're looking from a perspective of, let's say, institutional trading when it comes to, let's say, currencies. Or actually, give me a quick second. We have products, services, club goods, commodity. Okay, so we'll go through all of them regardless, and then we'll be able to understand a little bit better. So in any efficient market, price and quantity occurs at a point where the supply curve, as we discussed before, meets the demand curve. Yeah, so we find ourselves in an equilibrium in price and quantity, and this point is indeed the equilibrium between supply and demand. So equilibrium prices and quantities can be used to model a broad range of markets and economical activities. What we'll go through next are a couple of illustration examples of supply and demands and how it actually works. So let's look into products themselves. A luxury brand, as it says here, restricts supply in order to maintain high prices and the status of the actual brand. So we give an example. Let's say they produce 10,000 units, Yves Saint Laurent, whatever it may be. They produce 10,000 units, yeah, of a particular handbag. The market would demand 1,000,000 units at a price below $100, at the actual price of $2,000. Demand, of course, is 1,000 units per month, and it takes the brand 10 months to sell the actual inventory itself. It is pretty much a logic, common sense when it comes to it. Regards to services, products as well. If I'm looking at commodities, which personally is, of course, it's much more important for me and my day-to-day trading, because I do happen to focus on commodities mostly. We'll be going through foreign exchange pairs, stocks as well, but my main assets are gold, silver, platinum, and palladium. Simply because supply and demand imbalance works tremendously well, and most of the levels that are actual levels, we could be, as a matter of fact, trapped and think that certain zones are supply or demand zones, but as a matter of fact, they're just supply or demand imbalance zones, and they're a very, very different aspect between a supply imbalance zone and a supply zone. A supply zone, it's pretty much a fact that the institutions will fill in their short orders for the market to continue to the downside, rather than when a supply imbalance zone is simply a zone that is not supply yet. So we don't have institutional, let's say, orders for sure at a certain zone. Institutions are not definite that they will be selling at a certain area, but it may have taken another, let's say, lower time frame demand zone out, or so on, and that establishes it as an imbalance zone. Are we trading imbalance zones? Absolutely. But instead of just placing a certain trade directly, we're looking into market confirmation. So confirmation on lower time frame zones, showing us that that particular zone is indeed a supply zone. A very simple example: if we're looking at a daily imbalance supply, for example, instead of me placing a trade, I will drop the chart onto a 4-hour chart time frame, and I'd be looking for a confirmation to the downside, either by a trend line being broken or another 4-hour demand being taken out, or whatever it may be. And as soon as that particular confirmation actually occurs, once price retraces to that particular supply, then imbalance, now supply zone, our order will be actually taken in. Back to commodities. A commodity is a good, that is sold into a market that is so competitive that individual buyers and sellers have absolutely no influence on the price and must accept a market price set by supply and demand. Any change to either supply and demand pushes the price up or down, as I said before, according to shortages or surplus in either supply or demand. So demand is driven by the consumer needs and, of course, preferences. In regards to needs and preferences, just to make a pause there, of course, we have an array and a huge we have a huge amount of different market news. For example, geopolitical news for when it comes to pretty much any asset. We're looking at quarterly reports, for example, when it comes to stocks and so on and so forth. But the most important part, of course, is that demand in the end of the day is indeed, especially when it comes to commodity, demand in the end of the day is indeed driven by needs and preferences. So you'd be able to look at a chart and see a certain demand zone, which is not quite close. I'll just give you a chart example, as a matter of fact. If we go, perfect. This is a trade. This is a trade. I'm going to be looking into crude. This is a trade that we have taken as a counter trend trade, and we bought oil. We've done a 13-to-1 risk reward ratio. So if you're looking at this particular chart on a weekly, we all know, and we know the reasons as well. Oil has been dropping tremendously. I'm dropping it on a daily. There's absolutely no way that any in their right mind would buy this particular asset, right? You would be looking for short opportunities ever since it fell, since the 70s, right? Well, on a 4-hour chart, we have established a demand zone. Quick second. And I'll show it to you exactly. There it is. Perfect. Right. So what do we have here? We had, and I won't go through it too much, but here we had a supply zone. Pretty much price came in, traced. Here we had a supply zone which was respected. Once this particular zone wasn't under, let's say, institutional attention no more, so they weren't interested in selling that particular market at that moment in time, we have a rally. I'm not going to go through the actual rules right now, but just to keep in mind, rally-based rally and drop-based rally represent demand opportunities, so long opportunities. Drop-based drop and rally-based drop represents supply opportunities, so shorting opportunities. Long story short, though, we clearly understand here, once the market took out the supply zone, we had a, there we go, we had a 4-hour demand zone, which took out opposing supply. Once the market came back to our 4-hour demand zone, give me a second, just to make sure that drop base rally fill in, yep, right there, that's the one. So once the market filled in on the particular demand zone, it respected and immediately went to our final target, which was this supply area here. So we bought on demand and we targeted supply, right? So if we calculate that particular one, we have entered here with a stop loss under our supply zone and a target, a final target on our supply zone. So we're looking at a 1 to 5 trade in this particular case with a, well, not a very minimal, with simply no maximal drawdown whatsoever. Market came in, filled in our zone, and immediately respected the demand zone, took off, and came back to our supply target. So in a trade scenario, when the market was here, for example, we had this already there. Pending orders were already set. Once the market comes in, fills in our orders. That's why it's a lot of people use the term set and forget when it comes to supply and demand imbalance. Because when you're doing it on a 4-hour daily, weekly, monthly charts and so on, your pending orders get in and you don't really think of looking every single day, hoping that the market will come to your level. Your pending order is in there. Your risk money management is set in place. You just let the market do what it's doing. Yeah. So back to our thing. So commodities, again, once through to commodities, because we pretty much stopped in the middle. So as we said, commodities, and that's one of the reasons that that I trade commodities so often, is commodities is a good that is sold into a market, as we said, that is so competitive that the individual buyers and sellers have absolutely no influence on the price and must accept a market price set by supply and demand. Any change to either supply or demand pushes the price up and down, as we already discussed and established that. Demand is driven by the customer needs and preferences, which of course may be influenced by geopolitical issues and many other fundamental factors driven throughout the market. But we will be able to connect these fundamental factors and weird geopolitical events to certain very important supply or demand zones into the market. And you'll see how the news come pretty much hand in hand with, in this case, the institutional order flow addressing their particular zones to be filled in and when they will be getting filled in. Supply, on the other hand, is driven by things like capacity, efficiency, and resource allocation. When, of course, demand declines, yeah, give me a second. There it is. Yeah. So when demand declines, supply will typically decline as lower prices lead firms to relocate these resources such as land, labor, and capital. When demand rises, of course, supply would also rise. So the more people buy, the more people would obviously be willing to sell. Also rises as higher prices attract more firms to the business and existing firms ramp up production. So it's a very logical, let's say, relationship between supply and demand as well. When we're looking at common goods, like air, water, ecosystems, there are a shared common resource. They have a fixed limited supply, right? So common goods are often used without cost, such demand tends to grow very quickly. This leads to an overuse of common goods, resulting in their depletion and, of course, deconstruction, applying a cost to use common goods. Yeah. Nonetheless, though, the important one that I would like to be looking upon, because I'm sure foreign exchange, there it is, foreign exchange, currencies. Yeah. Supply. When you're looking at let's say Euro USD, supply of a currency is set by the monetary policy of a nation. That's why in regards to the dollar, the Federal Reserve Funds rate, it's very important. When it comes to the euros, the European central bank interest rates is really important. So one of the most important fundamental, if you want to put it that way, factors which will, especially when it comes to trading currencies, and because of that, considering their let's say invergence or divergence relationship with a certain commodity or another asset, of course, other assets will be impacted as well. But most importantly, when it comes to currencies as well, supply of a currency is set by the monetary policy of a certain nation, and demand is generated, of course, by economic activity such as trade and investment flows, growth, GDP, and so on and so forth. There's a lot of fundamental factors that help us understand if we are in a demand-driven market or, of course, a supply-driven market. Yeah. If we're looking at 8 examples of the law of supply and demand, in a way, the law of supply in principle, that an increase in price results in increase, of course, in supply. Yeah, we've already established that. And the law of the demand is the principle that an increase in demand results in an increase, of course, in price. The more people are buying, the more people will be interested to buy, and of course they will be willing to pay more. The more people are buying, the more people are, from a seller's perspective, the more people are interested to sell, and of course the demand will be driving price higher up to a moment in time in which, as I said, the amounts that are being bought by retail traders in this case, or institutions, no matter, equals the amount that is obviously being sold. That's when we reach that economical equilibrium in price and quantity. And based on the 4 rules of supply and demand, the 4 major rules of supply and demand, then we will be able to establish our trading decisions. So let's look into a price decrease demand. Yeah, the basic direction of a demand curve points down as people generally demand less of a good when, of course, it's more expensive. About that, there it is. Yeah. So we have the price curve. Yeah, and we have the units, the amounts that people are purchasing. When price in this case was 30 and it's dropping, less and less units are obviously being bought. Same exact, it's the same exact, well, it's exactly the opposite when it comes to price increase in supply. The basic direction of the supply curve points up as the market participants will find ways to increase supply, of course, as a higher price is obviously offered. I'm purchasing here, of course, the price will increase. More demand increases the price, creating more supply. That pretty much makes sense. If BMW comes out with a brand new model and it's overtaking its competitors, for example, the more people purchase that particular car, obviously it creates, logically speaking, more supply. So for example, they're actually giving us a television show talks about the health benefits of particular fruit. Other media outlets pick up on the idea and a large number of people start buying that particular fruit. Demand increases dramatically, driving, of course, prices up. Farmers see prices and begin to allocate land, labor, and capital producing the fruit. In the following years, the supply of the fruit obviously doubles. Very, very logical. In regards of a supply decreasing scenario, increased supply results in a lower price. The more people sell, the lower the price, of course, will be driven, right? So for example, if there's 10,000 computer science graduates each year, they might each have multiple job offers and be in a good position to negotiate a high salary. However, if the number of computer graduates, where is it? If the number of computer science graduates suddenly jump to 1 million, salaries would drop as the competition for each position would become obviously more intense. Supply increases demand sometimes, and why sometimes we'll be seeing exactly afterwards. In many cases, more supply ends up creating more demand, of course, by pushing prices down. This isn't always true because if you're supplying something people don't want, it will not impact demand at all. However, a product with healthy demand will generally see an increase in demand when supply increases. For example, if the supply of apples double next year, prices would tumble and some consumers would buy more apples based on the price comparison with other foods. It's pretty much common sense. What I would like to do though, in regards to these particular supply and demand imbalance rules, I would like us to go through some charts and understand exactly not the rules of supply and demand imbalance, but understand in a way how to draw supply and or demand imbalance zones and supply and demand actual zones themselves. Right? we'll go through a couple charts. All right. We have four, as a matter of fact, I'll be even going through charts. We have four rules of supply. We have four different candlestick formations of supply and demand. Yeah, we have a cold, and we should actually take notes of these. These will be the first very specific rules when it comes to supply and demand candlestick formation. So what we can see, ladies and gents, from a microeconomical perspective, and actually taking that and applying it onto a microeconomical candlestick charts in order for us to see exactly where that market will be moving towards. Is it going to reach a higher price for equilibrium, or is it going to be dropping towards a lower case of equilibrium? So very, very important. The four supply and demand candlestick formations, 2 for supply, 2 for demand, and we'll go through them as well. So first one, we're looking at demand. It is rally. So we see a rally in price. Then we see a base, so an equilibrium in price and quantity. And then we see another rally. So rally, base, rally represents demand continuation, meaning we are in an uptrending market looking to buy. Very important. We have drop, base, drop. We're talking demand, so drop, base, rally. We are in a on a higher time frame. We are in a demand rally base rally, demand continuation, uptrending market, we're looking to buy. Drop base rally, again, we're looking to buy. We are in a demand reversal, downtrending market, looking to buy, counter trend. And then supply, where we have drop, base drop, where we are in a supply continuation, looking to sell, yeah, and a rally base drop, yeah, rally base drop, where we are supply reversal, yeah, looking to sell, counter trend. So rally base rally. Before I go on to the chart as well, I'll give you the actual rules as well. Remember, in the beginning of this particular episode, we discussed 3 different time frames in order for us to establish our trading decision. I was telling you how I trade 6 month monthly, 6 months, 3 months monthly, or monthly, weekly, daily, or weekly, daily, 4 hours, or daily 4 hour, 2 hour, or 1 hour, for example. Yeah. In order for you to be able to establish your actual trading decision, I'm going to be using for this particular series. I'll be using the rules and the time frame sequences that I personally use in my day-to-day trading. and that is monthly, weekly, daily. Sometimes we're looking at weekly, daily, 4 hour in order for us to take maybe an intraday or a swing position. But usually 99% of the time I'm looking at monthly, weekly, dailies. Nonetheless, we'll be doing a monthly, weekly, daily formation in order for us to establish a rally-based rally and a drop-based rally, positions that we would have bought the market, and of course a drop-based drop and a rally-based drop, positions where we would have been selling that particular market. So looking at a rally-based rally, these are also very important things that we need to establish. So if we're looking, before of course we take any trading decision, we need to understand if we are in a downtrending market or uptrending market. And the bottom line remains that if I'm in an uptrending market, for example, if I'm looking at a monthly, weekly, daily formation, if I'm in an uptrend on a monthly, then logically speaking, I will only be looking to buy, to go long in an uptrending market. If I'm in a downtrend from a supply perspective, from a monthly perspective, then of course I will be looking for short opportunities. Do we have the chance to make a little buck on as a counter trend trade? Absolutely. Why? Because we have the formations to actually allow us to do so. Again, it does take it is directly connected with your appetite of risk. If you are the kind of a trader that would comfortably take risk to sell in an uptrending market or to buy in a downtrending market, that absolutely no problem with me whatsoever. It all has to do with the way that you approach the market. Bottom line is that I'm going to show you how these particular levels form, most importantly, how they get established, and even more importantly, how to actually use them for us to, of course, take advantage. So the rules that I personally follow, you're looking at monthly. If monthly is up, weekly is up, and daily is up, the action will be for us to buy or long on daily demand zone. If the monthly is up, the weekly is up, and the daily is down, we'll be looking to buy on weekly demand zone. If the monthly is up, weekly is down, and daily is down as well, we'll be buying on monthly demand zone. Yeah, these are the three purchasing opportunities, and exactly the opposite. Monthly is down, weekly is down, daily is down. We're looking to sell on daily supply. Monthly is down, weekly is down, daily is up. We're looking to sell on weekly supply. Monthly is down, weekly is up, daily is up. We're looking to sell monthly supply. Yeah. This little bit here will be pretty much the most important part when it comes to you developing your supply and demand imbalance trading strategy. It's very, very important because it will be connected to your directly to your risk money management strategy, and of course it'll show you exactly where to not only where to enter the market, but most importantly where to exit that particular trade. When you purchase something or you sell something, do you just let the position in, or you look at the profit and you say, that market looks good there, let me close my position because I made $100? Absolutely not. You require a reason to enter, which we'll establish. But very importantly, equally as important, of course, is the reason and the time and the price of exit. And what exactly establishes that. So if we're looking on the screen, rally-based rally, demand continuation, uptrending market looking to buy, drop-based rally. So let's start with a rally-based rally, demand continuation, uptrending market looking to buy, because we don't really have a lot of time left. Yeah, so we're looking at a rally base rally, demand zone, continuation. This is a trade that I've actually taken before. Okay, so on a monthly chart. Looking here, yeah, what do we have? I'm going to just establish the particular trades for future reference. Within the next few episodes, we'll be discussing trend lines, trend line break, most importantly, how to establish if you're in an uptrending or, of course, downtrending market, and how to take advantage of these opportunities. I just want to show you exactly what a rally-based rally would be looking like, and how exactly a trade would have been taken. So we are looking, in order for us to establish, we have to be looking from a monthly perspective. We have to be looking at our peaks and our valleys. And at the moment in time in which we have taken the trade, I was looking, we have valley, peak, valley. Done. So if I would have connected, sorry, this is not my computer. Give me a quick second. Extend to the right. Boom. Okay. Perfect. So what do I know? Peak valley, peak valley, peak valley. So if I connect my last two peaks, and my valleys there, when I drop my chart, yeah, I can clearly see that this particular trend line here has been broken, right? At that moment in time when I was looking at, has been broken. So we have our valley, our peak, and our valley connected after this particular trend line break, right? What else do we know? So I know as a fact that at this moment in time, when I drew this, forget about what happened there. At this moment in time, when I drew that, I know as a fact that I'm in an uptrending market, right? So on a monthly. So if my monthly is up, that I know as a fact that I'll be looking to purchase that asset. But I need to know my weekly and my daily. So I can know if my monthly is up, weekly is up, and daily is up, I would have bought on a daily demand zone. So let's see how it went. So monthly was up. When I'm looking on a daily, give me a quick second. There we go. When I'm looking at a weekly, so we have peak, valley, peak, valley. When I was, allow me to delete these. So I know the monthly I'm up, beauty, peak, valley, peak, peak, valley. Wow. There we go. Yeah. Perfect. Yeah. So I've connected my trend line as well. I know as a fact that this was a supply zone right here, which actually worked as a gem every time the market came to it. Yeah. So I know a monthly I was up as well. Brilliant. So because the moment in time when I wanted to buy, where is the rally based rally that I've just want to give you an exact rally based rally trade, so you see it. So monthly is up. I don't have a rally based rally here, as a matter of fact. I do. Okay, so right here we have a rally, equilibrium in price and quantity, a rally away from it, broke my supply, market comes back, right? So that is my demand zone. I'll show you exactly how supply and demand actually works. So in this moment in time, if I go to monthly, wow. A quick second. Beauty. So at this moment in time, that's where I wanted to place my trade, right? So if I'm going to monthly, we already know that in this moment in time, so the market was here. Whatever happened here, give me a quick second, ladies and gents. I'll be using the Medicals platform for future reference. Where's my demand zone? Beauty. So that was my rally base rally. Again, if I go monthly, just to, at that moment in time, we were monthly up, so we've taken the trend line, we connected our peak, our valley, peak, valley. So we connected our last two valleys, and we clearly know that monthly we're up. We were here. Forget about, as I said, forget about what happened there. We actually do not know, and we don't care. Right? So we are at this moment in time here. So we know we connected. There it is. We connected valley, peak, valley. Connected our last two valleys. I know that monthly I'm in an uptrend. I was in an uptrend. Weekly speaking, my trend line was broken to the upside. Clearly uptrend. I can also connect. Valley, peak, valley, peak. So monthly up, weekly up. And daily at that moment in time, we're also up. We have a rally base rally, so we connect our peak, valley. So our last two valleys connected. Daily was also up. So what do we have in regards to monthly up, weekly up, daily up? We would be looking to buy on a daily demand zone. So what was my daily demand zone? That was the daily demand zone, was the zone that actually broke that particular trend line. So the market came rally base rally, market came in, filled in its zone, took off. In that particular case, we would have had a 1 to 5. A 1 to 5. We risk 100, we would be making around $575 on that. Or you risk 1,000, making around 5,070. Actually, give me a second. Let me just put the exact target that we would have stopped our trade at. We would have banked our profit. Where was the exact target? So I am trading to establish, so monthly, I took it on a daily. My target would have been the opposing monthly supply zone. Where is the opposing monthly supply zone? Rally base drop, fill in left, fill in left. 1, 2. Brilliant. I'm going to delete that. Doesn't really matter. I just didn't want us to see it. That's why. I'm going to delete this. And if I'm going on a daily, monthly is right there. So that's my monthly supply zone. I've entered on a daily, targeting the opposing monthly supply zone. So considering that we have entered on a daily, our final target would have been on this particular monthly supply zone. And indeed, we have rally base rally, market came in, filled in, our trade would have been triggered. And the final target would have been here on the monthly supply zone, where according to our monthly, weekly, daily sequence, we would have been actually selling. So we closed our long and we would continue to sell on that particular monthly supply zone. As pretty much happened, but I will be going through that at a later stage. Nonetheless, this is a rally-based rally. For the next episode, actually, for the next week, what I'm going to be doing is we'll be getting live assets on. For example, we'll take 5 majors and 1 important commodity, and we'll be able to look at rally-based rally, drop-based drop, rally-based drop, and drop-based rally, and how exactly to take these particular positions. When to take them as well. Once we establish the imbalance zones and how actually to get them drawn, then we'll be looking into the risk money management part of things in order for us to understand the exit of every single trade. But again, that will be a little bit in the future. Now, please do accept my apologies. I know that we started a little bit late today and we had a little bit of a technical issue. I had much more prepared to go through with you guys, but we'll do that in the next episode, or maybe maybe we'll be able to film an episode in between these two, so I can actually continue establishing the core rules that we need to understand before we actually go into charts. Nonetheless, as a matter of fact, because I saw a message before I let you guys go on AUD-NZD. Someone said that there may be, okay, so AUD-NZD right now at this moment in time from a monthly, weekly, daily perspective is not tradable. Why isn't it tradable? Because I do not have an actual trend when it comes to my monthly, right? Why don't I have a trend when it comes to my monthly? Valley, peak, valley. So I've got valley, peak, then I don't have any other valley. This is not a valley, and that's not a peak, because that's not a high than that. That's not a low than that. So if I was to connect the actual valleys, I connect these valleys. Yeah, and if I was to connect the peaks. So unless this is actually broken and gives me an actual understanding, monthly up for sure. For example, here, I know as a fact that monthly's up, right? Right here. I knew as a fact that my monthly's up, yeah? Valley, peak, peak, valley again. So from that perspective, if I saw this chart, for example, forget about this huge, ugly volatility there. Nonetheless, if I saw that chart, I know that within this zone here, I'm looking to buy. Yeah. So from that perspective, unfortunately, the signal that I saw on Skype, it's not something that I would personally trade. Nonetheless, if I'm looking on it, I know as a fact. What do I know as a fact? 100%. I know as a fact that this demand zone here has been broken. End of the story. There is no buying opportunity on this. My trend line has been broken. There is no buying opportunity on this. Daily, no buying opportunity whatsoever. 4 hours. There we go. So that's why. On a 4 hour, bang on where that particular trend line was touched, we have a 4 hour demand zone which took out an opposing daily supply zone. So if I was to look at this from, I can't look at it from a monthly, weekly, daily perspective, right? We already know, understand why, simply because the monthly is untradeable, right? But if I look at it on a weekly, daily, 4 hour perspective, let's just see. We clearly understand that right now, this 4 hour demand zone has been touched. Wow, what a beauty. I'm going to delete that. Wow, what an absolute gem. And this is what I'm talking about, ladies and gentlemen. Supply and demand, in the end of the day, it's extremely precise, and it comes smack on the pip. Extremely low maximal drawdown, which is extremely important as well, right? Peak valley connect. We have rally, base rally, beautiful demand zone. I'll just take, actually we have two demand zones, that and this. So I'm taking both of them together. My trade then, in this case, if I wanted to do a counter trend trade, then our trade would have been triggered today, right? Yes, our trade would have been triggered today, already in the money. So that is your 4-hour demand zone, yeah? That was your 4-hour demand zone, yeah? Right here. Right here, I won't go into details on how we established that particular zone. Nonetheless, it is a very valid. It took out an opposing daily supply zone. Very important area. Yeah. Rally base rally. What is this beauty here? What is this lovely candlestick here? That used to be supply. Yeah. Fill in left. Fill in left. Fill in left. Rally base rally. Broke. If price ever comes back here, we would be buying according to the rules. So price did come there, right? And we bought, in this case, we would have bought here with a stop loss right underneath your 4-hour demand zone and a target of 3 to 1. There it is. So at this moment in time, the trade would have already been activated and would be actually going. And just to continue on that trade, if I'm not mistaken, AUDNZD, it was a trade signal that has been given by FXB to their clients as well. That's why I wanted to analyze it, just to see if indeed that was a legit trading signal. And I have to admit that yes, it was. Right now, the market's pretty much making almost a 1-to-1. So you'd be able to, once the market hits the 1-to-1, according to your risk money management ratios, you could then close half of the position and bring your stop loss. For example, let's say the market actually does hit a 1-to-1. Where is a 1-to-1? A 1-to-1 will be right there, right? Boom. So if my market indeed, and I'm quite sure it will, if my market indeed reaches a ratio of 1-to-1, then I can easily close half of my trade. I bring my position, my stop loss to 0. And if the market retraces, it kicks me out, but at least I've actually made, let's say, a 1%. If you're risking 1% per trade, once the market comes to 1-to-1, so you're making 1% of your trade, right? 1% of your equity, let's say. Closing half position will bank you 0.5%. Bringing your stop loss to entry would guarantee you that particular 0.5% in the worst case scenario if the market turns against you. So, or you could just let the market continue. Nonetheless, this was a perfect 4-hour demand zone. So whoever came up with that signal, probably Mr. Steven Spector, the analyst from FXB Trading. Congratulations on that. That's a spot on trade. I'd like to remind you as well that FXB Trading is offering money management services in collaboration with an asset management firm from Marshall Islands, Gain Pips, and they're also offering interest on your funds on a yearly rate of 6% as well. These two combined together, having an account under management, together with a 6% interest rate, together with a very well-established risk money management strategy, which you will be able to go through with the analysts from Gain Pips and FXB Trading. I personally believe that a day trader or a long-term trader or an investor that doesn't really want to be connected to the markets from a perspective of trading, finding opportunities themselves and so on, and just simply comfortably having their money being traded in a certain manner, I strongly suggest to close an appointment with your account managers from FXB and put you in touch with these analysts from Game Pips as well, in order for you to be able to make a trading plan which will include your assets being managed plus a 6% yearly interest as well. This is it for today. Next time it will be much more in depth, of course. Do keep in mind this was the first episode. We had a little bit of a tech issue in the beginning. Next time we'll do a proper charting session. If you guys want, do send an email to your account manager or anybody here at FXB Trading with a certain asset or a bunch of assets which you guys would like me to go through on supply and demand imbalance ratios, and I'll do exactly just that. We'll be able to build our own portfolio here, and every single week we'll be able to go through those assets, analyze them, and see exactly where we are, set up our pending orders, and make sure that everything is done in the correct actual manner. Wishing you a great one. Stay in the green. Till next time. Thank you much.